The real question right now are where are investors putting their money? Because you have crypto down, stocks on thin ice, and real estate is also frozen.
Yeah, the S&P, you guys know, is down 19% just in the last month. Bitcoin, who knows where that's going? I keep hearing buy the dip, buy the dip, buy the dip. It's down 22%, and it's tough to cash flow.
Yeah. Crypto is, I think, down over 30%.
It could be, yeah,
right now.
Last I looked, and it's really really hard to find real estate that's cash flows, right? And I think you welcome guys to an economy that I'm used to. Like this is like what we just came out of is just made us all soft, right? And so the reality is where are people alternatively putting their money? What should we be doing in this last couple months? What should we be doing in 2026? We got a lot to talk about.
Yeah, let's start with crypto. So crypto's kind of been all over the place. Right now it's down, 30 to 40%. And everyday investors are pulling back because most people can't afford to lose 30 to 40% of their investment, especially if they're older, which is leaving, the hardcore traders left there. As we said with real estate, mortgage rates are at 6 to 7%. Sellers don't want to give up their 2 to 3% loans, and an average home buyer can't afford payments at this price. So that's going to give you just a record low transaction volume. And with the stocks, the stock market's down, and a lot of people are betting on certain stocks like tech stocks. But other than that, the rest of the market is pretty down.
Well, even that's volatile, right? So the one thing that's up, which is interesting, is silver and gold. And silver hit 50 and gold's over 4,000, as you guys know. And gold was at 3,000 in March. So this year. And I went to the gold conference, which was very, very interesting. There's nobody from real estate there at all. So it was all these mining people and gold people and oil and gas. It was pretty cool. It's a New Orleans investment conference. And obviously it's a gold conference. So it's like, take this for what it's worth. But I talked to multiple people. And they all think that gold is going to get over 5,000, somewhere between 5 and 7, and just kind of settle in that.
Where's it
area.
at right now?
It's at 4. Now, I'm not pitching gold. I'm just trying to tell you that we're all trying to figure out where should we be putting our money now? What is going to run? It's really, really hard to find cash flowing real estate. That's for sure. We have been able to do it, but it's much, much more difficult, and it does not look like rents are soft, inflation. Who knows? But loan to values, we're only getting in the 50, 55, at the most 60% LTV on any of that stuff. So you got to put a lot of money down. So the economy's a bit in flux, and we're heading into the end of the year and another potential rate cut.
Yeah, so basically the three major investment pillars are shaky right now, and the main question is where is capital going? And I went to an investor event last week, and that was everyone's sentiment, right? I mean, a lot of the people had rentals and they weren't getting the returns they wanted on the rentals, and they were considering selling them. But then the question is okay, you sell them, where do you put the money? You can't just sell them for cash, and do nothing with it. That's even worse than having the rental property. So that is kind of the big question. And that's a lot of what we're hearing in our investor community and what we wanted to talk about today.
Yeah. And I think we got to take a look at what are the top risks. So if I'm looking at risk, I'm looking at, certainly you've got market risk, right? That's number one. Now, market risk would be like, Detroit, I guess, or Portland or Seattle or San Francisco. That would be, from a real estate standpoint, market risk. Conversely, it could go the other direction, as you guys know. Interest rates, another obvious risk there. Now, the one thing that you do have with interest rates is you can control them. You can actually do fixed rate instead of variable. So there is a little control that you have with interest rates. Another one is inflation. We don't know where that's going to go, but if inflation is going up, I don't think it's going down. Certainly, the Fed wants to bring it down to 2. It hasn't been there for some time. I think it's right around 3 at the moment. So that's something that you need to consider. And if you are considering that, then you need to be in what would be considered a hard asset, something that would rise with inflation. And then there's business risk, which is if you're investing in a company that could get disrupted, right? Like whatever that kind of business is. Like I was watching this video with Gary Vee talking about Google. Now, obviously, Google's huge. Don't get me wrong. I'm not saying that they're at risk. But what I'm saying is you're talking about Google ads versus ChatGPT and how Google ads aren't going to be a thing. That entire division is going to go away. So you start to look at business risk, and then of course you got the economic risk. So those are all the risks, I think, and so you just have to, from there, figure out what are your controllables inside of those things, and there are controllables. There are things that you can pay attention to and actually direct your money toward.
Yeah, so let's look at the data and where the money is actually going. So if you look at the stock market, AI remains strong, even though there is volatility. There has been $4 billion in inflows, and this tells us that people are, being very selective, in the stock market, what they're investing in. But the biggest thing is cash balances are at an all-time high. So your money market funds have $7.48 trillion, and that's up from $6.5 trillion just last year. And T-bills are also up as well for investment purposes, and their rate is 3.7% right now. So what you have to look at with that, there's a lot of money sitting. That is the biggest takeaway from this, is people don't know what to do with their money, and it's just sitting.
Yeah, and I think things are. There's nothing wrong with being a neutral, right? Like this is a time where I think it's probably good to figure out if you have any cash leaks, right? Like fix those, and sit back. Because the one thing we were talking about before is that the Fed is meeting next month, actually just in a couple of weeks, and they don't have the data that they used to have because of the government shutdown. Mm-hmm. And so this could be neutral for them too. We could roll into next year potentially with the rate where we are, which is, in my opinion, not a big deal. But I don't know. The sentiment has been all over the place, below 50%, that there's going to be a rate cut. I think last I looked at was actually a little bit above 50%. But the reality is they don't have that data. But we are moving into quite a consumer time, right? There's a lot of year-end tax moves that people will make. Certainly, there's a lot of things businesses do right now that they can do legally to mitigate tax. Things like bonus depreciation, as an example, where you can buy things in Q4 and write them off in that year and then get to use them next year. So that could happen. Also, the holidays and all of those things, there's some kind of a temporary employment boost during this last quarter that we always see historically, albeit temporary. It's not a guiding light for sure. But I think while this is all going on, it's probably not a bad thing to just hit neutral. I think just kind of move and just keep looking for that cash flowing deal if you can find it.
Well, and that's why you're seeing a big play on metal, right? On gold and silver, is because really that's just an inflation hedge too. It's no different than, putting your money in a savings account or anything else. It's just parking it and then being able to use it later. And, we have people commenting on the YouTube that they are small investors that own single families, and they're in the same issue. It's like, my single family is really not cash flowing that great, but like, what would I do with the money? And so, let's talk about why investors are parking right now, why they're not investing in things currently.
Well, I think you can bank on the government right now, right? So you can go into the 1-month T-bill, for example. That's easy. Some of those kinds of things. But even the S&P is down. I looked in just 1 month, 19%. Not that that's government, but I'm just saying that I think you can be okay there. But Going into cash right now with uncertainty is a good thing, right? There's a lot of unknowns, and I think waiting it out. The surprising thing has been gold and silver, right? And that's actually a surprise to everyone, even people that are in the space. They're like, we've been waiting for this forever, and now it's here, and in fact, it might be a good time to roll into our video sponsor, Monetary Metals, which is our paid partner for this video.
Gold is near all-time highs, but appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate, but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control, and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk, and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more.
So let's look at why investors are shifting this way. And we should probably start with the real estate, affordability issue.
Yeah, for sure. I mean, you guys already know, but we are heading into the year of the renter, right? Maybe two, right? Well, what happened was we had a lot of new construction that got started a couple of years ago when rates were lower. And what you're seeing now are the fruits of that. You're seeing that these projects are getting completed. They're being delivered to the marketplace. It's creating a lot of supply, and supply is what lowers prices. So right now, you are going to see an affordability change a little bit, at least for the renter. And that actually, if you think about it, is going to be a little more stressful for that Airbnb market, for that single family market. You are going to see soft rents, I think, through 2026. At least that's what we're banking on. We just had an annual conference for my entire company, and Ross and I got on stage. I said, I don't think that 26 is going to be a better year than 25. And the reason is we're wrestling with our expenses every single day. It seems like with insurance and property taxes and utilities and all the things that we do there. But then on the other side of it, we're starting to see concessions in the marketplace. And so from that standpoint, from a housing affordability, I think if they're renting, the renters are going to see a little bit of a pause there. But I don't know if they're going to see it on the other stuff that they also use as well. What do you think?
Yeah, I mean, I think, people, the average home buyer still can't afford to buy. And you have to put a lot down to make a deal cash flow in most situations. And that's fine for people that are sitting on a bunch of cash and they want to utilize it. But that's harder for the person that, wants to just put down a little bit of money, 20%, and make it cash flow. It's very hard to find that in today's market. And even last night we ran into a listener, I believe his name was Paul, but he said he used to buy a house in the summer, flip it, and then sell it, and then that money paid for his school for the year, and those kind of days are just done, right? You can't flip homes that easy. Things don't cash flow that easy. You need a significant amount of money to get into the market in most situations through traditional financing. So I just think that, it's a tough place for people to have money. I think people that are already in it, that bought for good prices, you're fine, but the people that are trying to get into it, it's harder. And then if you go look at crypto, it's down 30%. Most people can't deal with that much volatility in their portfolio. So that people are kind of backing away from that to an extent, unless they're super knowledgeable on crypto. Your stock market is stretched. They keep talking about a stock market crash. Don't know if that'll happen, but at the same time, the stock market is highly leveraged on tech. And so if tech doesn't perform, that could create waves in the stock market. So everybody's just very like, what do I want to do? So they're just putting money into gold and silver, and they're putting money into, savings, basically, money markets and T-bills.
Well, I think that for some of you that are, beginners or are active, this is a time for you to sit back and look at diversification. And I think that could be the point of this kind of neutral spot, right? Like, all right, where am I too heavy in one spot? Like there was a time where I was extremely heavy in real estate, and I didn't want to be. So then I moved into oil and gas, I moved into gold and silver, and I moved into things that I didn't understand to the point that I knew real estate. Obviously, Bitcoin, stocks, we're not against those things. So what happens is, when you do diversify into those other things, and you got to figure out your own allocations, but then at least you got something, right? Like there are certain things that we're doing really, really well on, right? And there are other things that we're not. And I think that in times where the traditional these kinds of items aren't doing so well, this is the time to embrace the alternatives, right? If they're predictable and you can mitigate some of the risks. So I would love to see your comments here in the chats of what maybe some of the things that you guys are looking at. One of the things that we're doing, as you guys we've talked about before, is we're starting to look at the billboard space, right? The billboard space is relatively new to us, but it's the counties hate them, the cities hate them, the states hate them because they consider them, taking away from the beautiful landscape, which I guess that they got a point there. But what it does is it kind of brings scarcity to that space. And so if you can get one, therefore there's less and the advertisers want them. So those are the kinds of things that we look at. Their cash flow, we get some tax benefits. So there are things that are can look good during this period of time, and I think that's precisely what we should be looking at. Is maybe this would be a great forum for people to put that in the chats here, right? What are you seeing?
Yeah, exactly. And also let's talk about what this tells us about the market. So because there's so much savings right now, there's a massive pent-up demand for everything. There's a massive demand for crypto if it goes down, for real estate if it goes down, for the stock market if it goes down. And, people feel comfortable entering in at these lower prices. There's so much demand there. So investors aren't not investing. They're just trying to get into a better, entry point and holding their money until they can do that. So that is very different from, other times of softness, right? Like in 2008, a lot of people didn't have any money to invest. I mean, properties were a fire sale, but nobody could get a loan and afford them. Right now, investors have a ton of money. They just aren't entering the market with it.
Yeah, and I think a lot of them do know that saving cash, if you're an investor, a lot of real estate investors are traditionally, historically poor cash-wise, right? Mm-hmm. Because they like to keep the money moving, right? And I learned long ago you got to have some healthy reserves, right? And Ross and I are in what we call the dry powder phase, which is, to your point, we're accumulating cash right now to try to take advantage of whatever's next. And I think that's a prudent strategy. I absolutely believe in the neutral spot right now, based on all the things that are happening, but you gotta, you don't also want to be careful you don't catch a falling knife, right? Like, who knows how far things are going to slide, right? I will say this: the majority of the wealth in America is sitting in the stock market. Mm-hmm. I can't imagine the powers that be are going to let that thing slide too far, right? Right? That would set the whole economy sideways. And so if that is one thing, I'm not advocating you invest in the stock market, but I'm just saying I'd be very, very surprised if they let that slide too far.
Yep. So let's give some practical advice for, the audience, right? So, it's not a bad time to hold cash right now and to wait, right? It's not a bad time to wait until, to kind of see what happens. The next few months are going to be interesting because what the Fed does will be interesting. Trump getting his new Fed chair in there will be interesting. The announcement of a potential 50-year mortgage could be interesting. There's a lot of the job market could be interesting. There's a lot of unknowns right now in the next 6 months.
Yeah, we have so build cash reserves, park some money into some government sponsored T-bills or some money markets or something like that, where you're just comfortable and don't go crazy trying to figure this out. And the other thing that you could kind of watch and learn your local markets, right? That's one thing. As I was actually just emailing this morning some folks. Where do people move in 24 and 25? And it was really, really quite interesting. What's going on? What states are losing people? What states are gaining people? Where are they moving inside of those cities? That all creates issues, right? If a lot of people move, it creates vacancy. If a lot of people move in, it creates demand. So I think learning your local markets and then just start underwriting deals, start looking at deals, start looking at market trends, right? And even if you're not buying, because it's practice. That's what we should be doing right now is practice. That's certainly what we're doing. In the multifamily space, we have this huge conference in January called the multi-housing council. I should know the name of that, but I don't. MNHC. Anyway, so that's what happens is there's a lot of people that don't like to list stuff at the end of the year. And so that's one of those forums where there's a lot of deal flow just rolling through that. I mean, there's last year was like 8,000 or 10,000 people or something. Like, it was crazy. And there's all these brokers bring all these deals to that conference. We go. It's great, and it's like speed dating. You sit down and you talk to these brokers for 15 minutes at a time, and they have like 15-minute slots, and you sit down and you look at whatever they're working on in their markets. And then there's a whole bunch of multifamily deals that roll out in Q1. I think the same thing's going to happen with single family, where you got a lot of things being delisted right now because the holidays. A lot of people, if they just don't want the hassle of dealing with something during the holidays, they're with family or whatever. You got all these other issues. And so Q1, I think things will fire back up. Just park it in the garage and then pull it out mid-January.
So I have to ask you about the billboards because everyone on YouTube is asking me about the billboards. So why don't you explain how a billboard deal works and grows value?
Sure. So the billboards typically have a lease, so this is important. So you don't actually own the land. So there's a lease on somebody else's land. So it could be a car dealer, let's say. Well, what you do, you approach a car dealer and you say, I'll do a rev share with you, and you do a 25, 30, 40. I've even seen longer leases. These are long-term leases. And you negotiate some kind of price for the lease, for a long-term lease. So that's the first piece. The second piece, you got to go to the local city council, whatever, the county, and you have to get the permits because they're not going to just let you put a billboard up, right? And there's two kinds of billboards. There's a two-sided billboard, which is called a static, and then there's digital. And the digital typically does 8 ads per side. So 16 ads versus 2 ads. Big difference. So one's basically like a flat screen in the sky. The other one's essentially a two-sided ad. You guys have probably driven by these 100 times. You see them along freeways. They're owned by people. They're owned. Trust me. It's a sneaky little business, but they're really, really hard to put up. They're really, really hard to find. A lot of people don't like to sell them because they're these great long-term cash flowers. What I like is that you can completely outsource the management and the occupancy of a billboard. to a third party. There's a lot of these third party companies out there that do this. The big companies, of course, Clear Channel and Lamar are some of the big ones. Just go on their websites, you'll see. And so if you want to advertise, you pick them, and there's an ad rate, and you pay, and that's it. There's a whole bunch of salespeople that go fill them. But the reason I like them is it's actually quite low on the personnel side. You don't have a lot of staff. It's an investment. They can be $500,000 to several million, depending on the location. I've looked at one with a buddy in LA off the freeway right off in Orange County that was extremely expensive one. But the ad rates are higher on those too. So it's just math at that point. But I like them. They fall in the category of a land improvement, which means that there are you can write them off in the current year under the bonus depreciation. So that's also good if you're a real estate professional. So for us, you buy one, let's say $500,000, you can write off nearly the whole amount in that particular year, and you get that back as a deduction and against your ordinary income, and then they cash flow. They cash flow extremely well.
So Eli asked, are cell towers kind of in that same category?
Yeah, so it's a great question. It's very similar. Yeah, we looked at cell towers, doing them on our self-storages. We used to do self-storages. We'd put a cell tower on there. Exact same concept. The cool part about a cell tower, oddly enough, is that once you build the tower, you actually have like AT&T and mobile, or T-Mobile and Verizon, all in the same tower, and you cut long-term leases for that. So exactly the same thing, a little bit different. But now, oddly enough, listen to this. I told you first. They're actually doing cell towers in billboards. Now that should go. So, yeah, imagine that. You're driving by these billboards, and you can stick a cell tower in them. So that's also kind of something that's happening to that industry now. So that means you could potentially get ad revenue, but then also the cell tower revenue as well. So very interesting business.
Awesome. Well, thank you guys for joining, and we will see you next week. Make sure to check out our podcast on Thursday. It's the Ken McElroy Show, and we're going to discuss the Fed's decision and how, what we think they're going to decide in December, if they're going to cut rates or not, and how that's going to affect everything.
See you guys.